Today, I am on Belvedere Island, which is pretty close to Tiburon, and it's funny because I grew up in a small town in Illinois called Belvedere, Illinois, and then now I'm here on Belvedere Island, and these two places couldn't be further apart. I mean, it's just night and day, guys, from where I grew up to Belvedere Island. Also, the spelling is different too. Where I grew up is V-I-D-E-R-E. Here it's V-E-D-E-R-E. So not sure what's with that discrepancy, but the views up here are stunning, and it's a beautiful place to go for a walk and talk about how all of these companies, all of these lenders are just doing whatever they can to push people into housing right now. And Zillow is joining the 1% club. And I don't mean 1% as far as top producers or income earners. I'm talking about lenders and mortgage companies that actually offer people a 1% down payment mortgage. You know, I covered a few months back how you had Rocket Mortgage be the first one to announce that they were going to do this and offer different people 1% down mortgages that basically can't afford to buy a home. And after that, you had United Wholesale Mortgage follow, and now we have Zillow doing the same thing. Because in case you didn't know, they're not just a website that shows real estate, they also are in the business of writing mortgages, and they're even going a step further, because basically how these programs work, the buyer puts down 1%, just like Rocket Mortgage, and then Rocket Mortgage would come in and pay the other 2%, and that's exactly what Zillow's offering to do. And they're going to take it a step further by actually offering you alternative where you can actually put down 3% as if you were doing an FHA, and then Zillow will still give you an extra 2% as your down payment, bringing you to 5% down. And basically they just give you this money at closing, and that's how it's done. And at the moment, this is only being offered in Arizona, but I'm sure it's going to expand to other parts of the country very soon if their little pilot program works out as much as they're hoping it will. But Zillow hasn't exactly been known for all their good ideas. In fact, they were in the iBuyer business and got absolutely creamed to the point where they had to shut down their iBuyer program because they thought they knew what every single house in America was worth and that they could just buy all these homes, turn around and flip them for a massive profit, and that would make Zillow rich, right? Well, that worked out so well that they ended up shutting the iBuyer program down because it was an absolute failure, and ended up losing a lot of money selling these homes at a loss, just like Open Door and many of these other iBuyer programs that have gotten hit big time with all of this. And Zillow's claiming that they're doing this for a couple different reasons. Number one is they want to help the home buyers. Of course, that's what this is all about, right? They want to make sure people can still get in and buy a house now that housing is at a 40-year low in terms of affordability. So that's their number one motivation. But of course, it's to make a profit as well, because they would like to expand their revenue streams, they say, because they want you to believe that, well, down payment assistance programs lower the barrier to entry into buying a home. And that's the feel-good narrative behind why they're doing this. But the reality is, guys, like, yeah, it's expensive to get into a home. And that's on purpose, because you need to have some financial responsibility, right? If you can buy a house for 1% down and you also are below the area's median income, do you think that's really the right person that should be buying a house in today's economy? Somebody that's struggling like that? Probably not. But yet, that's what they're trying to tell people of why this is a good idea, and these guys are the good guys for offering this to people. And they're also claiming that because rent is so high, it's making it hard for people to save money, and the down payment is the biggest barrier to getting into buying a home. And I've seen other statistics on this as well, where the down payment is actually the biggest barrier for people because they just don't have the budget to save the extra money to get into the house. But think about this for just a second, guys. I'm not against people buying homes, especially first-time home buyers that want to have a place that's their own and they want to own real estate. But what I am against is being lied to, okay? Because think about this. When somebody doesn't have the money to actually save up a down payment for a home, do you think they're going to have the money to pay for that $8,800 repair bill like I mentioned yesterday in that video that comes up by surprise, or the $20,000 roof that might come up, or the myriad of other things that can come up when you own a house. This is what I keep telling people, and I'm not just saying this to say it, I'm saying it from my own experience as well. You know, as somebody that has owned investment property and also my primary residence, things come up and it's expensive. And if you don't even have money to save for a 5% or even 3.5% down payment for FHA, guys, you're not ready. You're not ready to be a homeowner. But these programs are aimed at pushing people into owning a house that aren't ready. And that's my biggest beef with it. I'm not saying that those people don't deserve to own a home or that they never should own a home. I'm saying that they're not ready. I did a hike right up there a few days ago, and I'll take you guys up there for another video one of these days because it's so beautiful up there. Sometimes it's a little windy though, but you can't beat the views, guys. So I'll take you up there definitely before I leave and show you just how magnificent the views are from the top of that mountain. So in order to qualify for one of these new 1% mortgages from Zillow, you can only make like 80% of the area's median income. So it's not like just anybody can qualify for something like this. There are income limits, and that's my other beef with it, right? Like, they're literally telling you that these programs are for people who don't make a lot of money. And for people that don't make a lot of money to jump in and buy a house right now when interest rates are 7.5% and prices are still pretty close to the all-time highs that we saw last summer, it's a recipe for disaster, guys. That's just the reality. Now, I do think that there's going to be a small percentage of people out there that are going to be able to take advantage of programs like this, and because they're so determined, like somebody like me, like I wanted to start this YouTube channel, I wanted to get it to 100K subscribers, I did whatever it took to make that happen. And there's going to be a subset of people out there that can take advantage of these programs and do whatever it takes to hang on to that house and make those payments. I don't care if you got to work 2-3 jobs. Some people out there will do it, but the problem is the vast majority won't, and that's where people hit trouble, because they get pitched these, you know, crazy ideas where you can just come in at 1% and have basically no skin in the game when it comes to buying this house. And as soon as things get rough, because you don't have any skin in the game, it makes it easy to walk away. How'd you like to walk up those stairs every day? Now, some of the other requirements that Zillow has in order for you to get a loan like this is you have to take a first-time home buyer course. The property needs to be your primary residence. Obviously, it can't be some sort of investment property. And you need to have a minimum of a 620 credit score. And that's my other beef with this too, because a 620 credit score isn't all that great. So 620 credit score, I know conventional loans will give you a loan when you have a 620 credit score, but that's not really a great score, guys. And you have to remember this: the lower your credit score is, the more you're going to get charged in interest, because only the most well-qualified borrowers are getting anywhere near the low 7s right now. And that means you have like a high 700s or low 800s credit score that's getting a 7.2 or 7.3% mortgage right now. Everybody else is north of 7.5%, probably 8% right now. So I personally think that all these 1% mortgage programs is just the final nail in the coffin when it comes to screwing over the last set of desperate buyers that think that they're never going to be able to own a home. You know, just like the balloon mortgages we talked about the other day, all these programs that they have available right now, and conveniently they're becoming available right now, right? When the housing market is really expensive and interest rates are extremely high, and we're already seeing prices start to come down. And that's when they're offering this, guys, because no one's making any money. So this is their last ditch effort to start making some money before it's too late. And if you fall for it, well, that's on you. At least I warned you. And what I see coming from all of this, except for the very resilient people that take advantage of all this, is I think over the next 4 or 5 years, we're going to see a lot of foreclosures, guys, because people that thought it was a good idea to take advantage of these things today and not put much thought into how they're going to pay for the cost of homeownership in the future, that's going to be the kiss of death for many people, unfortunately. And you know, foreclosures take a long time, guys. As soon as the economy goes into any sort of official recession and unemployment starts to meaningfully go up, that's going to be the end for many people. Once they go into the foreclosure process, it might take a couple years for those properties to hit the market, but I think that's where we're headed with all of this. And guess what? The Fed is very likely to continue keeping their interest rates higher for longer. That's what they've been talking about this past week, and basically they're not done, guys. There's a very high chance that at the next Fed meeting, they're going to raise rates yet again. And a lot of this is due to the fact that the price of rent is not coming down to where it needs to be to really reflect in the Fed's housing data in order for them to say, okay, we can stop with the rate hikes, because rent was 90% of the increase in inflation that we saw when it went from 3% to 3.2%. 90% of that was because rent prices and the cost of housing is too high. Now, according to apartmentlist.com, in July, rents fell 0.7% nationwide, which is hardly anything, but at least it is starting to go in the right direction. And one thing that's helping rents go down is we're getting this massive supply bump this year in rentals to the tune of 1 million new rentals on the market just this year. So I guess this Jackson Hole speech that Powell gave is going to be a big party pooper for everybody that was counting on mortgage rates to be 5% by the end of this year. You know, I covered this earlier this week, guys, that all these experts kept predicting, oh yeah, you know, it's going to be 5.5% by the end of this year. And the next year, it's going to be back to 4%, and everything's going to be right in the world when it comes to the housing market again. Like, these guys were so wrong, and at this point it just sounds delusional. Because housing is such a big part of the inflation problem that we have now, I think it's going to be a very long time before we see low interest rates again. And this ultimately, guys, is what I think is going to help bring the market down. And I'm surprised it hasn't done more already, but the thing is, I got sent this story from Steve, and what this story says is part of the problem is all the wealthy people that are hanging on to real estate. During the pandemic, when interest rates were extremely low, you had a bunch of very wealthy people take advantage of this, and who wouldn't, right? If you have millions of dollars sitting around and banks are giving away money basically for free at these low interest rates, and back then real estate was still cheap, why wouldn't you buy a bunch of it? And that's exactly what they did, according to this story. Because what it says is the most credit-worthy borrowers are at the top 10% when it comes to income levels throughout the country. So the top 10% were able to scoop up the majority of the available credit, because you also have to think the more income you have, the more assets you have, the more of credit will be available to you versus somebody that only makes 50 grand a year. So somebody like that could potentially buy 20 or 30 houses during this run-up that we saw in the market versus that one person that's lucky if they can even afford one. So this extremely low cost of credit really helped boost and juice the housing market to levels that we've never seen, and now we're only starting to see the downfall of that, and things sort of start to reverse, but definitely not as fast as they went up. And of course, that's why you saw so many bidding wars and people able to offer this crazy amount of money. First of all, if you're competing with someone that has a far higher income than you and has more money in the bank, they can afford to pay more for that property. But the other side of this story is a lot of people who bought these properties were looking at turning them into short-term rentals. And it's reflected in how many short-term rentals we have now throughout the country. I think it was over 2 million Airbnbs we have now in the United States. And here's where I think the story starts to fall apart a little bit, because you had people buying these properties thinking about turning them into vacation rentals, right? Short-term rentals. And they're saying, well, instead of renting it long-term for $2,000 a month, I can get $10,000 a month if I turn this into an Airbnb, so it's a no-brainer. But here's where the problem comes in. These people that bought these properties started bidding on them and paying prices that were built in with these type of returns, okay? So instead of factoring in, well, I'm gonna get $2,000 a month, they're factoring in, I'm getting $10,000 a month, so I can afford to pay more because I still have a healthy profit margin there. And that's the big mistake a lot of these wealthy investors made, I believe, because Airbnb might not last forever, guys. And we can see that in certain places where it's already being completely banned. Like Dallas recently, no more single family homes can be rented on Airbnb in most parts of Dallas. Okay, so if you're in a regular neighborhood, no more Airbnb. So if you bought a property there thinking that this was going to be your business model and forget about the $2,000 a month, I can rent it for 10, and now you can't do that anymore, well, now your only option is going to be to sell that property or to turn it back into a long-term rental. And here's the problem though. When they turn it into that long-term rental, because they overpaid for the property by so much, the numbers aren't going to work. So they're going to be losing money every single month on that rental, which most people who are smart with money are going to say, this is a bad idea, let's get rid of this place. So they'll likely decide to sell. So I don't know how many people out there exactly did this and bought these properties when we had this run up in the market, specifically intending to use them as short-term rentals and not running the numbers on a long-term rental. But say it was 500,000, guys. Well, that's about how many homes we have on the entire US housing market right now. So if those people decide to sell, we just doubled the inventory. So basically the main argument that this story is making, that it's not a shortage of housing that we have, it's a hoarding of housing that we have, that too many people at the top of the food chain own too many homes for sale. And that's why you have the government now looking at different programs where they might give people capital gains increases in terms of the penalty for capital gains for selling a house right now. They're looking at waiving different types of taxes if you do sell a property, in order for people to list more properties on the market right now because there's such a shortage of inventory. Now, there's not a shortage of homes, there's just a shortage of inventory. So we just don't have those homes listed on the market. So when I read stuff like this, what I typically think is that there was so much speculation because the interest rates were so low and prices were still pretty good for a long time, that so many people jumped into the market, wealthy and average, middle income alike, wanting to become the next big time real estate investor. But how many people actually bought these investment properties based on the rents continuing to go up, right? That's another problem. You even forget about Airbnb for a moment. If people bought these properties thinking that the rents are going to continue to go up forever, and that's how I'm going to make this investment work, that's another big problem. Because we just talked about a little bit ago how rents are finally dropping, and they were down 0.7% throughout the entire country in the month of July. And the Fed needs to see that continuing to go down in order for them to stop with the interest rate hikes, guys. So that's the other missing piece of this puzzle that so many real estate investors are facing, because even if your property cash flowed when you bought it, that's another problem, because expenses have gone up so much over the past few years in terms of home ownership that this can easily put you in a situation where a property that was once profitable 2 or 3 years ago no longer is, because the property taxes keep going up, especially when it's an investment property, because the caps for how much it can go up every single year are much higher. Like in Florida, for example, if you have a homestead exemption, they can't raise your property taxes more than 3% per year. But if it's an investment property, it can go up by as much as 10% a year. That is a huge difference. Same thing goes with insurance. When it's an investment property, you pay a higher insurance premium than when it's your primary residence. And so those expenses are skyrocketing in places like Florida and California and these really hot investment markets. But just because those areas are getting hammered with these expenses, it doesn't mean that other areas aren't getting their fair share as well. So I think it's going to be very interesting to see what's going to happen to all these people that invested in real estate during this time, if they're going to be able to hold on. So if the economy remains strong, I think many of them will be able to hang on. That's the other side of the coin, guys. The longer the Fed keeps the interest rates higher and the higher they continue to raise them, then the worse the economy is going to get. And remember, the interest rates have a lagging effect. So it's going to take a while for you to feel it, but when you do, we're all going to be feeling it pretty hard. Now, one thing I love is when you guys write me in the comments and say things like, you know, I watch all your videos, I love your videos, and every single time I walk away with at least one little nugget of wisdom, and I love hearing that. And I want to end this video with that one last little nugget of wisdom, because this is something I didn't even know. And apparently, when you're a renter, sometimes your landlord requires you to have renter's insurance, or sometimes you just want to get it because you want to be protected, right? Maybe you have a lot of expensive things, or you know you can't afford to replace everything in case something happens. Okay, well, did you know that if you're a renter and you live in an area that might have a flood, you're not covered? Even if the landlord has flood insurance and you rent that place, your items, everything in there that's your stuff, isn't going to be covered in the event of a flood. So you need to get your own flood insurance policy as a renter. I had no idea, never heard of this before. Apparently this is not something that renter's insurance will cover. Surprise, surprise, because that's how they make their money. So that puts the tenant in the position where they have to get a flood policy issued by a private insurer or the National Flood Insurance Program. Apparently they're saying it's affordable though, as low as $100 per year. Just another expense, guys, another thing that makes your monthly housing payment go up. Now that you have to worry about something like this. And I'm sure most people aren't going to do anything about this, but it is something to consider if you live in an area that could get a flood. I mean, look what happened when we had Hurricane Ian. A lot of those people that were renting probably lost everything, and if they didn't have this coverage, that's it. Everything's gone. Just something to think about for all you renters out there. If you enjoyed this video, make sure you subscribe to the channel, and if you don't want to wait for my next one to come out, check out this video on the screen right over here, and I'll see you in the next one.